All right. Good morning, everyone. It's Tim Davis coming to you guys with another productive and hopefully useful video. Today is Friday. It is now about 4:45 in the morning on Friday, March 10th, 2023. Again, March 10th, 2023. And I wanted to do a separate video on the tool that I've been using for a number of years that helps track overall market sentiment. And this is it's good to have a sentiment gauge of the overall market so that you're not caught on the wrong side of the trade for too long, not knowing what's about to happen or what is possibly preparing the overall market for, what the overall market is about to be prepared for. So that's what a good true market sentiment gauge can do for you, is that it can give you a fair warning of what we could be about to experience. Now, I want to start by looking at this tool, by taking a step back and look at the longer term picture. Again, this is the SPXA 200R, which is the tool that tracks the S&P 500 companies that are trading above or below their 200-day moving average. So that's pretty much what it does. It is a percentage gauge. It tracks the overall percentage of stocks within the S&P trading above the 200-day moving average. Okay, and in a nutshell, in general, the more stocks you have rising towards and above that 200-day moving average, it gives a sense that the market is more bullish. Than overall market sentiment has a bullish tone, bullish narrative. As that percentage starts to dissipate and starts to turn lower, that means that the overall market sentiment is starting to turn more negative or more bearish. Okay, that gauge over time, you can see drastic if you see drastic reversals in that gauge, then that's something that you really want to pay attention to, because if there's a drastic reversal in that gauge, it will eventually turn and bleed into the overall market, because that means there's more stocks that are being affected by such a move below or above there is 200-day moving average. Now, this particular indicator or gauge, you can actually look at it in multiple different percentages. You can check you can change that 200 to a 50-day if you want to check the stocks that are trading above their 50-day moving average. You change it to SPXA 50R. But I like to stay focused on the bigger picture, and by paying attention to more well-defined, because the 50-day gives you, it's a lot of noise in there to me. But if you look at the 200-day, that gives you probably a better insight as to what the market is showing us, the overall sentiment or the overall gauge of the market. Now, right now I'm looking at a monthly chart of this tool. And what I want to highlight on this monthly chart is some key turning points or key pivot points that history has shown us over the past 20, 30 years by paying attention to this tool. Now I'm going to show you way back to 2005, 2006, how this tool, if this tool was available back then. I'm not even sure if folks were paying attention to the overall sentiment of the market by using this tool back then or not. But there's a key level that is a strong level, or normally a strong pivot point level, to pay close attention to, and that is the 50 level. The 50% level of this particular tool normally gives you some strong insight of a possible turning point or possible gauge to watch to see what the overall sentiment is about to do at that 50% level. So back in 2005, from 2005 to about 2007, you'll see that this overall percentage of stocks trading above the 200-day moving average, between that time frame, it continued to hover or bounce, get a strong bounce from right around that 50% level, as you see me have circled here. So every time the percentages are pulled back around to that 50% level for several years, it has bounced from that level. Which means overall market sentiment was pretty much at a standstill or pretty much range bound until you reach to about, there was a strong one right there between 2006, 2007. Until we got to between 2007 and 2008, all things changed. So again, this 50% level is normally the a sign of a possible turning point. So that is a level that I always pay close attention to, because that is normally a sign of some type of a turning point or a pivot point, or just a gauge to follow, because normally if we are bouncing off the level from the upside, then normally it's telling us that the bulls are still trying to stay in control of that market. But once we break this level in a major way, that's a sign that the bears are starting to take full control of the overall sentiment of the market. And vice versa. Once we break the level on the upside, it's telling you that the bulls are starting to trying to take overall control of the sentiment of that market. Now, another key level to pay close attention to is the highest point. Normally, if we reach that highest point, which is normally anywhere between 90 to 100% of stocks trading above their 200-day moving average. That's like when we're at extreme levels, when the market is extremely overbought, the sentiment is extremely high. That means the market is normally almost just about extremely overbought. When you get to those extreme levels, then you can expect a reversal in overall sentiment, which would lead to a reversal in the overall direction of the market. Now, the highest level we have on record, which is what made me really start paying attention to this, is a level that we reached back in 2021. Right after the COVID plunge, 2020, market ricocheted right back up, which led people to believe that we are in a new bullish market. But to me, that was just a snapback, strong snapback rally that we had after the COVID plunge, not signaling that we are ready to start a new bull market, but signaling that something else was brewing. A quick snap, the quick drop we had, and then a quick snapback over the course of a year. The way that market ran after we've been in pretty much a strong bull market almost for 20 years or so, lead me to really pay attention to the highs of this particular indicator. And we got almost to 100% of stocks trading above their 200-day moving average at 0.97. Folks, that's an extreme level. That's an extreme level to the upside. When you see such an extreme level, either to the upside or to the downside. So extreme level up to the upside would be close to 100%. Extreme level to the downside would be close to 0, which is what we reached, or almost reached, back in 2020. I think we got very close to it. And we definitely reached that level of 0 back in 2008, 2009. So when we get close to the extreme level to the upside, we can definitely expect that the overall sentiment of the market will probably start to shift, which is what happened in 2021. As you can see, the overall market sentiment of the market started to trend downward. A lot of folks probably weren't paying attention to, because there were a lot of stocks within this time frame that was still showing a lot of strong sentiment to the upside. But that was when you see stuff like that, if you pay attention to this tool, you would have understood that a lot of those stocks that were still showing a lot of strong, up movement or strong bullish tone to the market was not given the overall picture of what's happening beneath the surface. And that's what I like to find out, what's happening beneath the surface, because you don't want to get caught holding a bag, because eventually if overall sentiment drops below that 50, almost every stock normally starts to be affected in some way, shape, or form. Almost, I always say almost, because you always find, a diamond in a rough, even within a bear market. So that is what we look for. We look for the extremes to the upside, and then we look for the extremes to the downside, because either way, got extremes to the upside, then normally the overall sentiment will start to bleed lower. And if you got extreme to the downside, which is what we had back in 2008, 2009, when the market totally got oversold, if you were a person who monitored this tool, you can almost tell when we were pretty much almost ready for a rebound or a return to the bullish market, because even back in 2008, 2009, clear this real quick. When we got down here to almost this zero level, look what happened with the market. You can tell that the bleeding was just about finished, because we started this tool just started hanging around here. It started doing what I like to say, some not sure what it wanted to do, or a lot of sideways action. So in this time frame, you probably had a lot of stocks that were still dropping, but you had some stocks that were starting to rebound as we traveled through over these course of months. Each one of these candles represent a month. So let me see if I can make this a little bit bigger. So during this course of these, this 1, 2, 3, 4, 5 month period between 2008 and 2009, the market was pretty much range bound. It was up and down, up and down. Overall sentiment was up and down, which means overall market price was doing the same. Until we got about that 6 month, then that's when you really start to see a strong push in sentiment up to the upside. That was a signal, once we got above this level, which is right around, I say about 0.1%, right about 0.1%. We got about around that level. This overall sentiment started to change in a big way. That would have been a signal for folks to really put down their bear hat and put on their bull hat and just jump right in. And you would have been able to recover much of everything that was lost over the course of from 2006 all the way to 2008. We've been able to recover a lot. So again, extreme levels is what I like to look for, and the 50% level. So extreme levels to the upside, extreme levels to the downside. Whenever we jump right around this 50% level, it really gets my attention. Again, so if you get to this extreme to the upside, pay close attention to a possible reversal between 2009, after we got that big ricochet from 2009, 2010, got to the upside right around close to 95%, and we hovered there for about a year. And then what happened? We plunged right back down in 2010, probably freaking a lot of people out. And folks were not really, prepared for a big sharp turn at such a big rebound in 2009, 2008, 2009, 2010. But then look what happened, just below the 50% level again, and the bleeding pretty much stopped and went right back up. Sentiment went right back up, almost to the highs again. Then right back down from 2011, throughout the year 2011, back down in a sharp way, right back down to about 20%. Then another ricochet to the upside. Then I think the strongest area for the bulls after that ricochet to the upside, 2011, was I would say right around 2012 to 2015, when sentiment pretty much almost stayed above that 50% level for quite some time. And that was a time frame when there was a lot of stocks that were doing very well during that time frame. Then there were some stocks that weren't doing too well, but you could have found a lot of stocks that were having a bullish narrative during this time frame in a big way. So now that I pretty much broke that down and showed you guys levels that we want to pay close attention to, now let's look see what's happening now in the time frame that we're in now, because something is brewing, and there's a lot of, and I use certain other indicators within this tool that I also use when I'm monitoring the overall our normal indices such as S&P, Dow Jones, NASDAQ, and Russell. So indicators I like to use in my trading style. I like to use the TTM squeeze, which is, I'm not sure, I think you only can get this on Thinkorswim, but TTM squeeze, which is you see these bars here. Normally the light blue bars and the dark blue bars on the upside, normally it's a sign of a strong bullish narrative. And the dark red bars and the yellow bars is normally a sign of a possible bearish, a negative sentiment. Once we start to turn from dark red to yellow, normally it's a sign that the momentum to the downside is losing its steam. Another indicator I like to use is the full stochastics. Full stochastics just pretty much gives you, sometimes it gives you some good buy sell signals, or on warning, should I say, because not everything to me is a true buy sell signal all the time, but that's why I like to use multiple indicators together. When you got more than one indicator, 2, 3, 4 indicators that are green and showing you some of the same things, and normally I pay very close attention to that. But the full stochastics, you have this negative line and this positive line. This positive line, which is the green line to me, the negative line, which is the red line, with the lines which make up the oscillator. Once you start to get a crossover, either the green on top of the red or the red on top of the green, normally signals a possible shift in overall sentiment. Like we're starting to notice right now, this is the monthly chart. So that means when you start to see a shift, that means you can start to see a shift for multiple months in a row. All right, keep that in mind. When you start to see a shift, you can see a shift for multiple months in a row. All these circles that I'm highlighting are pretty much pivot points. You're starting to see some kind of shift. There's a stronger shift right there. There's a shift. So each one of these pivot points, normally you see a shift in overall sentiment. This was a strong one right here. That was in around April, July of 2021. It was a shift to the in the full stochastic, signaling a possible move to the downside, and that's pretty much what happened. And again, it lines right up with the overall percentage of stocks trading above their 200-day moving average, hitting almost a all-time high, almost 97% of the highest we ever got in history. Almost 100% of stocks above the 200-day moving average. You hit that level, something's got to give. The highest you can go is 100%. You're not going much higher than 100%. Only you can do is trade sideways and stay up in that level, but that normally doesn't happen that often. Then I use the Williams percentage, which is also a good gauge to tell you of oversold and overbought conditions. When the Williams percentage gets above this upper line here, you are in a overbought condition, and that could last for a bit sometimes. But once we start to make a major dip out of that level, we get down about halfway, and you know that the overall sentiment is shifting to the downside. And we look for oversold conditions, as we were here for quite a while, from around October 2021 all the way till about October 2021 all the way till about August or September of 2022. And then we know what happened after that. Right around October, October 2022, we started to move up. And then last but not least, I like to use a CCI indicator, which also gives you it takes a lot of noise out of some of these other indicators. So gives you a clear picture of when we are about to possibly see a pivot point. The upper red line shows you overbought conditions. The lower red line shows you oversold conditions. And when we reach those levels, I start to look for possible pivot points. Here is a strong pivot point here, right around between April and July of 2022, signaling a possible reversal back to the upside. And that reversal probably started to happen right around here. Big up, big down, and then right around October, we got the big move to the upside. Those indicators I like to use on this percentage tool, sentiment, and also on my major indices. Now, get back to what the overall market is showing us now. So now, with that out of the way, look at the CCI. Looks like we are starting to hinge lower after we've been in overbought. If we made it to overbought conditions, it's starting to hinge lower on this particular tool, signaling a possible chance of a possible crossover that's possibly about to happen in the near future. This is a monthly chart. So if this happens in a monthly chart, that means that the overall sentiment could stay negative for quite a bit, for quite a while, at least for several months or so. That's what the CCI is showing us. Wins percentage showing us we are starting to hedge lower, because if you look at the wins percentage, after the ricochet in October, we got into overbought conditions. We pulled back just a little bit, the sentiment went right back up, and then look what happens. Here is, mark this pivot point right here. We dropped, sentiment dropped below this pivot point. So by dropping below that pivot point, that's almost a confirmation that the overall sentiment is turning negative or turning bearish. Okay, now when we drop below that level, look at, if I was to draw a straight line from where we drop below this level right about here, I would draw a straight line all the way up. You'll see what I pointed out to some folks who may have paid attention to my video about a week or so ago. We were in an unknown funnel by bouncing. Once we got back above this 50 level again, we made it back up to about 75, and then look what happened. Big, strong red candle with a long wick on top. Push the sentiment back below 70 and back towards 50. And if you paid attention to all the indicators, that signal pretty much was noticed or seen across the board, across all of these indicators, that a shift was probably about to happen. So where we're at now, we are back at the already around this 50% level. Stocks trading above that 200-day moving average, and look like it's threatening to break that level. And what's showing me that we probably will, strong indication that we can break that level. Look at the full stochastics. It's about to cross the positive line, is about to cross below the negative line, which means that the red line will be on top, signaling a possible bearish move to the downside and overall sentiment, like we did here back in July, between April, July of 2021. We're starting to get a crossover a little early before we got to overbought conditions. TTM squeeze, you can see that the TTM squeeze, even though you got these yellow lines that are signaling a possible sentiment moving to the upside, it could be about to stall out right here. So that's why I like to use multiple indicators, because one indicator could be showing you something else and the other indicators could be showing you something different. I like to go with the majority rules. So even though the TTM squeeze is showing us that the momentum to the downside is just about over, and we're starting to shift to a more stronger bullish narrative, the other indicators are going against that theory. With these full stochastics starting to show a move to the downside, wins percentage already broke below a pivot point, and the CCI is starting to turn lower. And the percentages themselves is showing you that we broke above 70 and then got a sharp snapback to the 50% level. So moving forward, what I'll be paying close attention to, and as you guys know, that on this week, we had Fed Chair Jerome Powell testifying in front of Congress. And if you've been paying attention to the testimony, it's been extremely hawkish. His testimony has been extremely hawkish, and he has no intentions of letting it, taking a foot off the gas pedal until he reaches this mysterious 2% target. So with that said, he's very data dependent. Depending on what data shows, I'm saying it's going to continue to push the Fed to keep its foot on the pedal. So I've been paying attention to data as it's been flowing out. Today we get initial jobless claims today. Next week is going to be the big one, which is CPI. If this indicator or this candle drops, start to drop below that 50% level in a big way, all bets are off. The overall sentiment of the market will probably stay negative for quite a bit, and we could be heading back down to around this zero level. So the shift has started. I believe this negativity in our market is definitely getting ready to pick up some steam, possibly. All right, so that's a breakdown of this tool, folks. I wanted to break that down. This is a monthly chart. Again, I wanted to show you guys how we are really pressing, starting to press a possible bearish negative if we break below the 50% level and stay below that level. And let me look at a couple other time frames. And then a weekly chart really shows you that this narrative is probably about to really pick up steam. So let me, a couple of things. The candlesticks themselves show you strong push to the downside. What happened when we initially, about a week ago, we initially hit that 50% level, the bulls fought back. Look at that long wick last week. Really. So last week, bulls fought back, pushed down to that 50% and push the percentages right back up. But then bears jump right back in on the week that we're in now. Look at that strong, solid candle that's forming now on this particular week. If for some reason today is Friday, if we don't get a pushback off of this level, turn this candle from red to green, and all bets are off, we will more than likely, sentiment will break below, well below this 50% level. Right now it's at 0.47, so I still say that's hovering right around the 50%. We break well below this level, all bets are off. Look at the full stochastics, how it's just racing to the downside on this indicator. Look at the wins percentage, how it's racing to the downside and already hitting some oversold territory. Look at the CCI also racing downward, starting to get very close to the oversold territory. So with that said, more than likely the percentages, you'll see these candles start to really push below this level as well. And then we have to see where we go. Some levels of support on this indicator right now. Where is this? So here's a level of support right around when I see shifts or changes. So right around this 25% level, 25% level, we can see some support be found. Right around here, we can see some support be found. That's about 0.25. So if we break below that 47 or 50 in a big way, you can see this percentage reach all the way down to 0.25. We have to see what happens. Then ultimately, the next level would be right around this, right around 0.1%, right around down here, around 0.1% would be the next level. And we break below that, 0 would be the final level before we see a strong move to the upside. So that's what the overall sentiment is showing. It's showing us a strong shift, folks. This strong red candle is what we are now. And when I see a strong red candle like with almost little to no shadow, this is a strong movement to the downside in this percentage. So now, even though I was just showing, I wanted to show you guys a breakdown how I use this tool and how it can be used to track overall sentiment of the market. Let's take a look at the futures market right now as we stand. It's now 5:13 in the morning. So let's see if the futures market is also showing us same type of, and then look at that. What do you know? And let me, so I got some other lines that I've been tracking here. So other levels of support resistance that I've been tracking here. So this is the futures market. And look how, and I just really drilled down to you guys what the overall sentiment was showing us. Look at the overall market. I told you, normally once the sentiment starts to change, the market starts to follow. Look what's happening with the overall sentiment of the futures of the S&P. But look at the red candle that's forming right now on the week that we're in now. Right there. And look closely at what it did. So here was last week's candle. We already dropped below that level already. Now, if some reason that jobs numbers don't come out today and don't push that back up towards 4,000, above 4,000, or back up towards 4,000 to 4,100, then all bets are off. This S&P will continue to bleed lower. So all indications right now, by looking at the indicators, are showing a strong push to the downside, or in general, showing that the bears have now taken full control of this market, folks. Let me move this. So it looks like the bears are starting to take full control of this market. If you paid attention to a video that I recorded about a week ago, I said if the market breaks below 4,100, then the next test level would be around 4,000. And I said if we break below that 4,000 level without any type of ricochet back to the upside, then the next level would be 3,900. We're at 3,900 now, right at that level, 3,908 right now on the S&P futures. And if we break 3,900, we can see 3,800 in no time, which is right around here. And right around 3,800, last time we got some sort of a pivot, as indicated here at the beginning of 2023. We got a little pivot here, right at 3,800 level, and we got a bounce. So the data between this week and next week, and definitely the Fed chair speak or rate decision towards the end of this month. March is going to be a crucial month for the markets, folks. If for some reason, when all this data starts to continue to roll out this month, if it doesn't find anything good that's going to help push this price action back up towards 4,100, and it continues to push price action towards 3,800, this month could be crucial with where or how we end up between now and ultimately the rest of the year. If this data continues to be, not good for the markets, the Fed continue to be extremely hawkish, then we could start to see a big drop below the 3,800 level of the S&P. And I'm going to draw your attention to one other target to pay close attention to. And let's draw this out to a monthly chart. Show you guys what we could be in store for. Let me get rid of some of these levels because I think that these are levels of the past for now. So let me get rid of this upper level of resistance that may be out of the picture for now. And let's pull up this monthly chart. Let me show you guys something on this monthly chart. S&P. So there's a lot of congestion looking at this monthly chart as we've been in this tight range. We've been in an extremely tight range. So on this monthly chart, this is the range we've pretty much been in, folks. Not breaking out towards these new highs around 4,808, 4,800, and staying muted below 4,200. So between 3,800 to 4,200 is where pretty much where price action has been hovering, folks, believe it or not. Not really making any huge strides by looking at this monthly chart. And this has been going on since around May, right around May of 2022. We've been stuck in this range. Folks, if we break out of this range to the downside, let me show you what we could possibly be in store for. We break out of this range, break below 3,800 in a big way. We will be in the process of heading towards the area that we broke down in 2020. So what the market really needs, the bulls really need to see is for price action to not break down below 3,800. If we break down below 3,800, folks, then the bears are really going to have a foothold in this market. Again, we've been range bound for almost the past year. So we've been range bound for about a year, folks. Keep that in mind. That the bulls were not really gained any huge ground over the past year. It may have seemed like it because there were a lot of stocks that were doing well, but looking at the overall bigger picture, we've been stuck in neutral for about over the past year. Looking at the bigger picture, with all signals now starting to point to a more bearish narrative, especially with the Federal Reserve starting to be more hawkish. Even on this monthly chart, we're starting to see sentiment starting to be, it looks very weak. Looks very weak on the monthly chart. So folks, be nimble, pay close attention to the data that's coming out, and pay close attention to these levels of support resistance, folks, because it's really going to dictate what happens in the near term and the longer term. Remember, we are still in the bearish market, so you don't want to get caught trying to chase a bullish narrative and get caught holding the bag because you didn't get out quick enough. Because when we have these bear market bounces or bull market bounce within this bear market, they find a way to quickly reverse in price action. So just keep that in mind. All right, folks, that's all I have to share with you guys on this morning. Hopefully this video is something that is very useful. Again, this was something that I wanted to point out when using the SPXA 200R and how to compare it to what's happening in the overall markets. Till next video, Tim Davis signing off, folks.